You know that feeling, right?
Yeah.
Like you're just drowning in financial news.
Oh, yeah. Nonsense.
1 minute it's all bullish, the next it's panic, headlines screaming crash, then poof, a rebound.
Exactly. And the tickers, the articles, what's up, what's down, what's hot.
It just never stops.
Yeah.
And you get that nagging question, don't you? Like, should I be glued to this stuff 24/7?
Right. Or is there maybe a saner way, a better way to get what's going on without losing your mind?
Precisely. So welcome everyone to our deep dive into exactly that, how to read the market without losing your mind.
Mm-hmm.
Our mission today, it's really to cut through all that noise. We want to pull out the key insights from, well, two giants of investing.
Yeah, we're talking John C. Bogle, like, the Vanguard founder, and the legendary Benjamin Graham.
His work with David L. Dodd really laid the groundwork for so much.
That's right. We're drawing mainly from Bogle's Common Sense on Mutual Funds and Graham's classic, The Intelligent Investor.
And these aren't just textbooks, are they?
No, not at all. Think of them more like roadmaps. They show you how to process all this information like the greats did.
Helping you filter the signal from the noise, basically.
Mm.
And, crucially, avoid that feeling of just being totally overwhelmed.
Finding clarity in all that chaos, that's the goal.
Okay, so let's start there. You open your news app, you check prices,
Mm-hmm.
and it feels like the market is just shouting a million things at once.
Mm.
It's a lot. How do we even start making sense of that daily flood?
Well, what's really fascinating is how Benjamin Graham himself thought about the market. He didn't see it as this calm, rational machine.
No. How do you see it?
He actually personified it, gave it a name, Mr. Market. And he described Mr. Market as being like a pendulum.
A pendulum.
Yeah, one that forever swings between unsustainable optimism, which, makes stocks too expensive,
Right.
and unjustified pessimism, which makes them too cheap. He saw it as inherently emotional, moody even.
Mr. Market, that's quite an image. So if this Mr. Market character is swinging wildly based on feelings, what does that mean for you when you're looking at those daily price changes? Are they actually important?
Well, this is where Graham's genius really comes through. He hammered home the point that a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business.
Right, a real company.
Exactly, with an underlying value that does not depend on its share price. So the smart investor, the intelligent investor, they're a realist. They ignore Mr. Market's moods. Graham said the intelligent investor sells to optimists and buys from pessimists.
Yeah, okay, let's unpack that a bit. So the daily price, the quote, it's like an offer from this moody partner, Mr. Market.
Precisely.
But it's just an offer. It's there for your convenience, not something
Yeah.
you have to act on, like someone yelling prices at you you don't have to buy.
That's exactly it. And if Mr. Market is constantly swinging, constantly emotional,
Yeah,
the big question is, how do you avoid getting swept up in that?
right. How do you keep your cool?
Graham's advice was really direct on this. He said, never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop.
Just don't react to the extreme.
Exactly. He was crystal clear. Market prices are just there for your convenience, either to be taken advantage of or to be ignored. It takes real discipline, though.
Oh, absolutely. And that ties in so perfectly with John Bogle, doesn't it?
Yeah.
He famously warned us, impulse is your enemy. Eliminate emotion
Eliminate emotion.
from your investment program. It feels like both of them, from different angles, are telling us the same core thing. Keep your head. Don't panic when others are.
Yeah, resist the urge to just do something every time the market hiccups. It's almost counterintuitive, isn't it?
It really is. We're kind of wired to react immediately.
We are, which is why picturing Mr. Market helps, I think. It sort of externalizes that noise, makes it easier to tune out.
Still, it's tempting, isn't it? You hear those stories.
Oh, yeah. Good gains.
The next big thing, someone who made a fortune overnight. It taps into that desire for a shortcut, a magic formula for wealth.
And we see these patterns over and over. Graham specifically warned about these speculative formulas.
Like what?
Well, he mentioned things like the January effect, this idea that small stocks rally at the start of the year. People would pile in hoping for quick profits.
Ah, okay.
He said these fads always sound the same. This is quick, this is easy, and it won't hurt a bit.
Right, the siren song.
But he pointed out these so-called opportunities just wither away once everyone knows about them. The edge disappears.
Makes sense, if it were that easy.
Everyone would do it. He even got a bit skeptical about complex math and investing. He suggested that the more elaborate and abstruse the mathematics, the more uncertain and speculative are the conclusions. Sometimes, he felt, Simple arithmetic was your best friend. Focus on value.
So basically, trying to predict the market's next wiggle or chasing these hot trends, it's usually a losing game for the average person.
For most of us, yeah, absolutely. Graham's core idea was that investing on the basis of projection is a fool's errand.
A fool's errand. Strong words.
He even said forecasts from the quote-unquote experts are often less reliable than flipping a coin.
Wow.
So for most people, he advised investing on the basis of protection. Protection from what? From overpaying and from being too confident in your own judgment.
So defense first. Don't try to be a hero. Just don't mess up badly.
Pretty much. Know that the future's unpredictable.
Okay, this is where it gets really interesting for me. If chasing trends and speculating is the enemy, then Bogle comes in with the antidote, right? Long-term investing.
Yeah.
He tells us, invest you must. Time is your friend.
Such a powerful idea.
Give yourself all the time you can. Compound interest is a miracle. That idea of time being on your side feels almost radical today.
It really does, and it leads right into another key concept Bogle talked about a lot, reversion to the mean.
Okay, what's that?
He called it that eternal force of gravity that seems to hold the financial markets in its grip. Basically, things tend to revert back to their average over time.
Meaning extremes don't last.
Exactly. And he used this to bust a really common myth. The idea that superior past performance is predictive of future success.
Ah, so picking last year's winning fund isn't the secret sauce.
Not usually, no. He gave a great example. The Legg Mason Value Trust. This fund beat the S&P 500 for 15 years straight, 1991 to 2005. Incredible run.
15 years, you'd think they'd crack the code.
You would. But then, from 2006 to 2008, it lagged the market by a stunning 43 percentage points.
Wow, 43 points. That's a huge swing.
What a massive reversal. It just highlights how hard it is to stay on top.
So funds at the top rarely stay there for long.
Oh,
It's like sports teams' dynasties end, right? Eventually, everyone kind of regresses.
That's a great analogy. Bogle's research backed this up strongly. He looked at top-performing equity funds from the 90s
Yeah.
and found that almost three-quarters of them, 72%, ended up performing at or below the S&P 500 index in the following decade. 72%. So chasing those winners was definitely a losing strategy.
Very much so. He even said it was almost symmetrical, like the first shall be last and the last shall be first. This wasn't just funds either. He saw it in global markets too. U.S. versus international stocks would trade leadership, but long-term returns were identical.
So the takeaway is, don't chase performance. It's likely to leave you right off a cliff eventually.
That's a powerful lesson, yeah. Humility is key.
Okay, so if timing the market is out and chasing winners is out, what about the funds themselves? Why do so many actively managed funds seem to struggle just to keep up with their benchmark, let alone beat it?
Now we get to the crucial role of costs. Bogle coined this fantastic phrase, the tyranny of compounding costs.
The tyranny. Sounds ominous.
It is, in a quiet way. He's talking about how even seemingly small fees add up to enormous amounts over long periods. He noted expense ratios for stock funds might range from, say, 0.2% on the low end to 1.5% for an average fund, maybe up to 2.2% or more for the really expensive ones. And these are annual fees we're talking about.
Annual fees. But they compound year after year, silently eating away at your potential growth.
So that difference, maybe 1%, maybe 1.5%, it actually matters a lot. It's not just pocket change.
Oh, it matters immensely. Bogle calculated that a simple equity index fund beat the average active fund by about 2.5 percentage points per year.
2.5% per year. That's huge over time.
It's massive. And he said a big chunk of that difference, maybe 2 percentage points, came from total fund costs. That's not just the expense ratio, you see?
Right, there's more.
Yeah, it also includes portfolio transaction costs, the costs of all the buying and selling the active manager is doing.
And those transaction costs, they're not always easy to spot, are they? They're kind of hidden.
Very much hidden, usually. Yeah. Things like brokerage commissions, bid-ask spreads. Bogle estimated these trading costs could average around 0.8% of the value traded.
Okay.
So think about it. If a fund has 100% turnover, meaning it replaces its entire portfolio every year, which isn't uncommon, that's potentially another 1.6% drag on returns each year from trading costs alone. Add that to the average 1.5% expense ratio.
And you're suddenly over 3% in total costs.
Exactly, a 3% annual headwind. If the market returns, say, 10%, you might only be keeping 7% before taxes. It eats up nearly a third of your return potential.
Wow. That is...
Yeah.
That's staggering when you put it like that.
Yeah.
And then on top of all that, you mentioned taxes.
Ah, yes, taxes, the often forgotten cost. Active funds, because they trade so much, Bogle cited turnover, often above 80% for equity funds. They tend to be very tax inefficient. Every time the manager sells a stock for a profit, it can create a taxable capital gain for you, the shareholder.
Even if you haven't sold your shares in the fund.
Even if you haven't sold anything. Bogle showed how this impacts returns. The original Vanguard Index Fund beat 94% of active funds before taxes.
Impressive.
But it beat 97% after taxes. The tax drag on active funds made the index fund look even better.
So the combined hit from expenses and taxes can be really devastating over decades.
Absolutely. Bogle called taxes the black sheep of the mutual fund industry because they're so often ignored.
It really sounds like, in many ways, the system is set up to benefit the managers more than the investors sometimes.
Well, Graham certainly recognized that potential conflict, too. He flat out stated that most mutual funds underperform the market, overcharge their investors, create tax headaches, and suffer erratic swings in performance.
He didn't mince words.
No. He basically said funds underperform by about the amount they charge in expenses and trading costs. That money, which could have been compounding for you, it's going towards those fees instead.
Okay, so let's bring this all together for someone listening. You want to invest wisely, you want to be informed, but you don't want to lose your mind to the noise or get eaten alive by these hidden costs. Is there a simpler way, a more effective path that cuts through the complexity?
Well, this leads us to the big question, doesn't it? If active management usually struggles after costs, what's the smart alternative? And interestingly, both Bogle and Graham, coming at it from different times, landed on a remarkably similar, elegant solution.
Which is?
Indexing and broad diversification.
Indexing.
Yeah.
Just owning the whole market, basically. I remember even Peter Lynch, the legendary active manager.
Yeah, Fidelity Magellan.
Exactly. Even he said something like, most investors would be better off in an index fund, which is pretty amazing coming from him.
It is, and Charles Schwab said something similar. Only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing.
The evidence seems pretty strong.
Bogle really emphasized this. Index funds reliably beat most active funds after costs. And just as importantly, he showed they involve substantially lower risks.
Lower risk, too. How so?
Well, because they're so diversified, they tend to be less volatile. He cited Morningstar data showing index fund risk metrics were significantly lower, over 30% lower in one period than active funds. It's just a smoother ride.
Okay, so you get market returns, low costs, lower volatility, and Graham liked diversification too, right?
Okay. He did. He made a really practical point. He said, look, for someone truly exceptional, like Warren Buffett, maybe diversification is silly because it dilutes their few brilliant ideas.
Right, for the rare genius.
But for the rest of us, for the typical fund manager or individual investor, he said, not diversifying is foolish. It's just too hard to pick the few winners and avoid all the losers.
So humility again. Don't assume you're the next Buffett.
Exactly. And he concluded very directly. The ideal choice for most investors is a total stock market index fund.
Just buy the haystack.
A low-cost way to hold every stock worth owning. That's the common sense he felt had carried the day. You eliminate stock picking risk, you eliminate manager risk, you capture market returns, and you minimize costs.
That sounds almost too simple.
Maybe. But often the most effective strategies are simple.
What about ETFs, though? Exchange-traded funds? They're hugely popular now, often used for indexing. Do they fit into this simple picture?
Bogle had some cautions there. He acknowledged ETFs often have lower stated expense ratios than many active mutual funds. But he pointed out those expense ratios can still be, 3 or 4 times higher than the rock bottom costs of traditional broad market index mutual funds.
Okay. Cost comparison is still key.
Absolutely. And maybe more importantly, he observed that ETF investors often underperform the ETFs themselves.
How does that happen?
Because ETFs trade like stocks, they make it really easy to trade frequently. And people do. They try to time the market with them, jump in and out.
Falling back into that speculation trap.
Exactly. And all that trading leads to poor timing and potentially higher costs, eroding returns. Bogle found ETF investors sometimes lost huge chunks of capital due to this behavior. The key is still low-cost, long-term holding. The structure, whether mutual fund or ETF, matters less than how you use it.
So the behavior is the critical piece. Don't let the tool tempt you into bad habits.
Precisely.
Okay, so we've covered a lot, how market noise and emotions driven by that moody Mr. Market, how trying to speculate or chase winners, and especially how those insidious costs and taxes can just sabotage your investment success.
Yeah, they really can undermine everything.
But the insights from Bogle and Graham, they really point towards this powerful, almost liberating idea, don't they?
They really do.
That simplicity, staying focused on the long term, and being absolutely ruthless about costs, those are your best weapons.
Your greatest allies, absolutely. It's about clarity over chaos, understanding the market's nature, accepting that forecasts are unreliable, knowing that costs compound.
Right.
Once you internalize that, you can step back from the daily frenzy. You get your mental energy back. You focus on what actually builds wealth over time.
Letting the market work for you instead of letting it work on you emotionally.
That's a great way to put it.
So, thinking about all this, in a world that's practically designed to make you react constantly, to chase the next shiny object, what's the one piece of noise you're going to consciously decide to ignore starting now? And what's the simple plan you'll commit to so you can actually read the market without losing your mind?